Gearing up for the long holiday weekend, how about perhaps taking in a flick? Well, Hollywood has been hurting and certainly hopes it'll now be a good ride at the box office. A lot of new flicks hitting. One company is capitalizing big time on the big screen. Nearing a new 52, I've got to see that, Madagascar. That's going to be big. Anyway, one company nearing a 52-week high and showing investors a healthy dividend yield to boot. An entertaining bottom line straight ahead.
Today we're gonna blow this dump. I did it!
Yeah, Hollywood hoping that you'll love those talking animals here at the box office this summer. Scene from Madagascar. While Hollywood is hoping for wild blockbuster results this holiday weekend, our next guest's bottom line is all about entertainment. We're talking about Entertainment Properties Trust. The REIT owns everything from megaplex movie theaters to bowling alleys. The stock has also been on an impressive tear, flirting near its 52-week high right now. So what is driving this growth? Here now with the strategy is David Brain, Chief Executive Officer of Entertainment Properties Trust. He joins us from Kansas City. Good morning, Mr. Brain.
Good morning, Brad.
Well, certainly your stock has been on fire, up 25% year over year. Revenues were ratcheted up 27% in your last quarter. How will you continue to drive this growth?
Well, the growth is still driving because the opportunity is there to still rescreen America, that is, develop new megaplex theaters to replace the older format Generation 2 multiplexes. And so that creates a lot of opportunity for us to continue to expand the company, expand the revenues and results.
Yeah, it seems expansion here is certainly the game plan here. Are acquisitions like you've made recently in Southern California really the key to grow the top line revenue?
Well, we have built into the organization, we think, around 4, 5, even 6%, 7%, depending on film content and percentage rents year over year without acquisitions. We've been delivering double-digit growth, 12, 14, 15% per share result increases, really because of layering on some of the very accretive results from the acquisitions. But we're in a good position, should the opportunities not be there, to still deliver very handsome returns to the shareholders.
Okay, David, let's talk about the blockbuster summer movie season here. And there's a lot of anticipation about Star Wars, Madagascar, the Batman flick and whatnot. But some analysts are saying, you know, Hollywood's not had a good year so far, and if the summer box office season is considered a flop, that you could suffer. Do you see it that way?
Well, our revenues are still 95% out of our base rents and about 5% participation rent. So it really won't affect our dividend-paying capacity. But the summer season has really jumped off to a good start with Star Wars. On a year-over-year comparison, last year had The Passion of Christ, Mel Gibson's film, which was really an anomaly. It was just such a performer. It skews the comparison year over year. If you look at 05 relative to 03, it's relatively flat, so we're not in a bad space. And last year with 04 was a presidential election year, so we had a relatively weak late summer, early fall that we expect to make up, be a very positive year-over-year comp, and actually catch up all that difference from the early part of the year at that point.
You know, when you look at yourself as a REIT, and with so much movement into DVD sales, cable, video on demand, and the price of a ticket at $10, which just, I can't even believe that's what we pay to go to the movies, do you see the company diversifying or being forced to diversify into other properties here down the road?
Well, no, I think the opportunity is still there, and America wants to go out. America doesn't want to stay home all the time and do all their entertainment at home. And $10 is still cheap relative to a lot of other alternatives. You think about sporting events, live theater, music acts, and so forth. Generally, you're gravitating to price points of $50 per capita. So it's still the bargain for $40 to $60 million average production value. It's still the bargain in America, and America wants to go out. You know, the VCR has been around for 25 years now. So, you know, home entertainment is nothing new. Format's changing. Maybe qualitatively it's increasing, but so is the theater experience as well.
Okay, well, let's talk about some of your expansion plans. I read here that you're talking about buying or developing a ski resort type facility for snowboarders. Tell me about that.
Oh, well, we have talked about the fact we've been looking at the ski industry, and in fact, we're always looking for opportunities where the industry is changing and there are opportunities to build a new state-of-the-art facility and a competitive advantage. And because of snowboarders not needing 3,000 feet of vertical drop and maybe more like, you know, 1,000 feet, and you can do a terrain park and you don't necessarily have to go way out of the cities, or you can go more attractively to urban, you know, population centers, we think there may be an opportunity. We have no investments there yet. We have been looking at it, but we have nothing announceable. So that's an idea, and it's representative of the type of thing that we may be entering to supplement, to add on to, not to replace, but just to add on to our position already in theaters.
Yeah, because that certainly seems like a departure from your core, so that's why I brought it up. It seemed interesting. Great performing REIT that you've got there over the last 5 years. I have to ask you, does a threat to the real estate bubble bursting force you to slow acquisition plans at all? Are you concerned at all with some of these acquisitions that perhaps you're buying at the top of the market?
Well, we're still buying basically on development and construction costs. We're not an auction buyer and a kind of a buyer of properties that have been in the market for a while. So we're very close, almost 90% of the time, to 90 to 100 at construction costs. And so we're not really in that bid bubble that other industries might be in. That's one of the reasons our yields have held up very well.
Okay, David, thank you for your time and have a good weekend.
Thank you very much.
David Brain, Chief Executive Officer of Entertainment Properties Trust.